Good evening and welcome to the Money Show, the show that puts your money matters front and center. In a world full of financial noise, we are here to bring you clarity, confidence, control over your personal finances, whether you are planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions. This is your space, your guide, and your daily check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because you're on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. Just need the right advice. So let's begin in and let's invite our guest on the show. It's Pankaj Mathpal, who will be answering your portfolio queries and helping you navigate all your financial investment decisions. Pankaj, hi, good evening. Welcome to the show. And let's begin with our viewer queries. And let's start with a very interesting question, because today all of these viewers have given you goal of 2 CR, 3 CRs in 10 years, 15 years. So I'm going to begin this from Rakesh. He's from Mumbai, currently investing in ICICI Large Cap 2,000 rupees, ICICI Nifty Next 50 2,000, ICICI Technology Fund 2,000, Nippon India Small Cap 2,500, HDFC Flexi Cap 2,500, Motilal Oswal Large and Mid 2,500, Parag Parikh Flexi Cap 2,500. Target is 2 CR, vision is 22 years, portfolio value is 3.5 lakhs. So, although I do want you to comment on his fund mix, but before that, let's just talk about this technology space, which is the results that we saw from tech definitely were better than expected, because there were almost zero expectations from the IT companies. But having said that, let's understand the ICICI Technology Fund, what kind of exposure it has, and when we talk about having technology space in your portfolio as a sector diversification, what's your take on it?
Kavita, good evening, and thank you very much for having me on the show. See, technology sector, as you said, that results are better than expected, but still, I'll say there's a lot of pressure on the sector. And in technology sector, there are two types of fund. One are like where there are pure technology stocks are there, and there are schemes where you see digital funds. For example, like there are quick commerce or food delivery app, that kind of companies are there. So I see better scope in those kind of funds where you see more exposure to digital funds, digital stocks. I mean, the companies which are more into the internet service providers, or this kind of businesses which we expect that will do better in long term than the service company. So that is why my suggestion that if he has ICICI Prudential Technology Fund in his portfolio, he should switch to a well or better diversified fund. For example, not that large cap, mid cap, but ICICI Prudential Mutual Fund has a scheme called ICICI Prudential Business Cycle Fund. That can be a better choice. So from technology fund, I suggest that he can switch to ICICI Prudential Business Cycle Fund.
All right, that's interesting take, but then we'll talk about sector diversification later. As far as the AMFI numbers are concerned, sir, we have seen a dip in sectoral and thematic inflow also, but that's a discussion for later stage. Let's talk about Rakesh's portfolio now. Your first take on his fund mix.
Yes, see, all the funds are good, but as I mentioned, that one is sectoral fund, where I already suggested him to switch from sectoral to thematic. And thematic also, when we talk about thematic, some themes are like long-term themes where investor can stay invested for long term. So that was one suggestion. Second thing, he also has one scheme which is index fund, ICICI Prudential Nifty Next 50 Fund. Along with this, he also has a large cap fund. Again, ICICI Prudential Large Cap Fund. So instead of keeping two large cap funds in his portfolio, my suggestion, he can stay invested with the active fund, ICICI Prudential Large Cap Fund, and he can switch from ICICI Prudential Nifty Next 50 Fund to Invesco India Mid Cap Fund. So otherwise, rest of all funds are good. These funds are also good, but to balance the portfolio, I'll suggest that two schemes he should consider to make changes. Rest everything is good. But Kavita, if you see the his target, as you said, 2 crore rupees in 22 years. But I think he has not considered inflation, or he wants us to calculate that. So if we assume 6% inflation, in 22 years, the value of 2 crore will be something like 55 lakh rupees today. So that is why my suggestion that he should consider increasing his target if it is after 22 years. But if I calculate that what he has accumulated by now, that 3,50,000 rupees and 16,000 rupees SIP, I'm calculating at 12% CAGR. And he, as he has said, that he can step up. Without step up, he can expect around 2 crore 31 lakh in 22 years. But because target, as I mentioned, that because of inflation, he should increase. So my suggestion, he should step up by 10% every year. And with this, he can expect around 4 crore 47 lakh in 22 years. So one thing, step up, he should consider. Second thing, two schemes, one that ICICI Prudential Nifty Next 50 and ICICI Prudential Technology Fund. He should exit from this scheme and switch to another scheme which I suggested.
All right. So that's the trajectory of investments if you want to achieve that amount. But then, yes, I think inflation counting is a factor that you will have to answer in all of these questions. So that's what I can see, all 2 crores and 3 crores in 15 years and 20 years. So yes, inflation counting becomes very important. But let's move to Ajay Kumar Singh's question. He says that he's 42 years old. And SIP target is again 15 years, 3 CR, started investing in this year, August, and he's got Bandhan Small Cap, Nippon India Small Cap, HDFC Mid Cap, Edelweiss Mid Cap, HDFC Flexi Cap, Parag Parikh Flexi Cap, 5,000 each fund, 30,000 is his SIP amount. And 15 years, this is what is the portfolio he's planned for himself.
Kavita, he has kept two schemes in each category. For example, 2 funds in small cap, 2 schemes in mid cap, and 2 in flexi cap. But as his target is 3 crore and horizon is 15 years, he can continue with these schemes. But yes, because portfolio is aggressive, he should expect volatility in the portfolio. If he wants to minimize volatility, in that case, my suggestion that he can reduce his exposure to small cap and increase to flexi cap funds. Otherwise, if you're comfortable with the volatility in short term, stay invested. In long term, definitely you can expect better results. Now, as far as target is concerned, there is a huge gap. With 30,000 per month SIP, if I calculate at 12% CAGR, in 15 years, Ajay can expect around 1 crore 43 lakh rupees. But because target is 3 crores, so here calculation says that he should increase his SIP by 6,000 per month. Means right now it is 30,000. Along with this, he should also step up by 10% every year. Then he can expect 3 crore in 15 years.
All right, very interesting. So these are the changes that one is recommended to do in his portfolio. But then that's again a very nice way to have a diversified portfolio. What do you think? One small cap, one mid cap, and one large cap, and you are sorted. Should that be an ideal approach for a basic portfolio, a basic, strong, fundamentally strong portfolio?
Exactly, I agree with you. One large cap, one mid cap, one small cap, and allocation should be higher in large cap and then lower in mid cap and lowest in small cap. That should be the strategy. But sometimes what happens, we have seen, like, for example, Quant Mutual Fund. There was a time when all schemes were performing better than everything. But then time came when we saw poor performance of almost all schemes from one AMC. So that is why sometimes investors think that keeping 2 schemes in each category may help them to get the average returns. So that is why that strategy is also okay if you have a good size of a portfolio. But to start with, it is always better that keep one large cap, one mid cap, one small cap. Or if you are starting only with 2,000, 3,000 rupees, so one flexi cap or one multi-cap fund can also be, can serve the purpose.
All right, so that's something that one really needs to keep in mind, especially if you're a first-time investor. Also, one question I wanted to understand, because major investment or exposure should be towards your large cap. But, we also advise our investors to maybe reshuffle or revamp their equity exposure. What should be that time when you should increase exposure in maybe a mid-cap or maybe a small cap? Large cap, definitely we need for consistency, for stability in the portfolio. But what should be the right time to increase money in a mid-cap fund or a small-cap fund?
See, one is strategic allocation. See, you have decided that you want to keep 60% large cap, 30% mid-cap, 10% small cap, something like that. In that case, if you saw that small cap has outperformed mid cap, small cap, and your allocation has changed now, the small cap where you wanted to keep 10% has increased to 20%, or from 20% has gone up to 30%. So you want to now reduce the risk in the portfolio, and that is why you want to rebalance. That can be one thing. Second thing is tactical allocation. Now you feel that at a particular point in time, small cap funds have potential to deliver better returns than mid cap or small cap, and that is why you want to have higher allocation for that time, for the time being. Means once you know that that means that particular market cap has plays out and has played out, and then you want to again bring your portfolio back to the original position. So one is, as I said, tactical, another one is strategic. So in both the cases, for example, if you see from 2021 to 2024, September 2024, small cap was outperforming large cap. So that there was a time when you could have higher allocation, but generally it does not work very well, because most of the time people take incorrect decision when small cap had already performed, and then investors started increasing their allocation. But yes, if you have good knowledge about sectors or market caps, so before these sectors or these market caps starts performing, and you increase your allocation in that particular market cap, will benefit you.
All right, it's time for a short break. But then before we slip into that break, I'm going to leave you with our WhatsApp number and our email ID, where you have to send across your questions so that our experts can help you and navigate all your investment strategies, align them with your financial goals.